This is the Chicks of FinTwit, a finance podcast by women for everyone. I am your host, Caitlin Cook. Join me as I highlight female trailblazers and their male allies across the industry as each shares their expertise on a variety of finance topics. Nothing is off limits. Thanks for joining us. Now please enjoy this episode.
All opinions expressed by Caitlin Cook and the Chicks of FinTwit podcast guests are solely their own opinions and do not reflect the opinions of the host or any of their affiliates. This podcast is for informational purposes only, is not investment advice, and should not be relied upon for any investment decisions. We are not recommending any securities, nor is this an offer or sale of a security.
Hello and welcome to the Chicks of FinTwit podcast, a finance podcast by women for everyone. I am your host, Caitlin Cook, otherwise known as Dead Kate Bounce on Twitter. And today with us, we have Leanna Orr. Leanna is an award-winning financial journalist and currently an editor at Pageant Media. Prior to that, she was an editor for Institutional Investor. In 2018, she and her co-deputy became the first women to run its newsroom since the publication's founding in 1967. Canadian by background, she's been based in New York City since 2011, where she earned her master's degree at Columbia University's Graduate School of Journalism, and her work has been featured in the Wall Street Journal, Forbes, Barron, Vice, and various academic studies. Leanna, welcome to the podcast.
Thank you so much, Kate. I'm very excited to be here.
Well, I'm excited to have you. For background here, of course, met Leanna through Twitter as I meet everyone. I think the first interaction that we may have had that I recall is a piece that you had edited from Nathan Yates, shout out to Nathan, on FinTwit Poker Night. So it's kind of fun to come full circle here and have you on the show. But I do want to start out, I gave a bit of a rundown on your background, but I always get very curious how, of all things within journalism, people get into financial journalism of all things, and specifically for you into institutional allocator land within that specific space. So I'd be curious to hear kind of the legacy story there.
Well, I think like all little girls growing up in Canada, I, had starry-eyed dreams of becoming a pension reporter. I think most of us do jobs that we had no idea existed until we were out of university. And I feel so fortunate that I landed here. I found out during journalism school that the self-consciousness that I'd always had about my quantitative skills. I grew up in a family of scientists. My father's a geophysicist and can do physics in his mind. My mother is the artsy one, and she's an architect, so she builds custom homes. My brother's an engineer, and so I grew up feeling like I was the one who was bad at math, and then went to journalism school, changed my context, and thought I'm actually okay at this stuff compared to these people, because we had to do things in journalism school like mandatory business exercises where you balance a budget, and to see all of my brilliant, much smarter than I am, much better writer cohort, my classmates, kind of melt down at balancing a budget. And I'm like, guys, it's just subtraction. Made me realize that if I have an edge in the business, it's probably being able to deal with technical subjects. And so I did a lot of science writing, business and finance classes. I'd taken quite a bit of economics in undergrad. And then my amazing career counselor told me in a no-nonsense way that if I wanted to stay in New York and stay in America as a foreigner, I needed to write about something that other people think is boring. You need to write about something that there's still a market for. And the New York Times is not going to spend $30,000 on lawyers and visa fees to hire a medium talented 22-year-old to write about theater. So I focused very closely on subject matter, on things I could write about that were both technical and had good business models. And so after a luminous 6 weeks spent making $10 an hour writing about tin for American Metal Market, my still current boss, Kit McDaniel, a fellow Canadian, brought me in to interview for a junior cub reporter position at a publication he had founded called Chief Investment Officer. And that was a print magazine, a kind of upstart, scrappy competitor to an institutional investor. And it focused very closely on what we call allocators or asset owners. So the people who work in-house at the largest pools of capital in the world, chief investment officers and their staff at pension funds, at university endowments, at large charities, at sovereign wealth funds, and now at family offices. So anybody who has enough money that you're on par with an institution. And I loved it from the very beginning. So almost 10 years later, I'm still on the same beat.
I love that. And the one thing I would mention there, first of all, the Canadian visa thing, we talked about this offline, but my roommate is a Canadian as well. So I know the struggles of, although being so close to the US, still having to go through that whole process and having that be pretty difficult. But going into talking about institutional allocators. So I'm biased on this, but had I stayed in traditional world rather than fintech startups, I was just fascinated with institutional allocators. I have some friends from Twitter, hopefully they're listening to this, shout out to them, that work as allocators and work on those teams. And for some reason, I've just always found it fascinating. But like you said, you were told to write about something that most people wouldn't want to write about, things that are perceived as boring. There's a stigma around institutional allocators for those who aren't in the space, that it's boring. And I think that that's pretty incorrect, in my opinion, might be biased, but why do you think there's that stereotype that institutional allocation teams are just like, it's really not as exciting as other beats that you could cover?
I think the biggest lie that finance has ever told is that you want to be an investment banker. That shit is boring. Sitting in your office wearing a suit from 8 a.m. and basically doing very little until 4, 5, 6 p.m. when the MD drops a bunch of please fix into your inbox, and then you spend the entire night painstakingly making slides for a deck that no one is ever going to look at, and if they do, they'll just click through it. It is flabbergasting how well branded so much of finance has become, that it's in some ways desirable, whereas the work of managing in-house money that is going to literally cure cancer in children, or educate the person who will one day fix climate change, or secure the retirement of nurses who've worked their whole lives and then don't have to worry about running out of money. To have that mission, while to not have that sneaking suspicion that the thing that you do is completely pointless and you're just taking rent away from people who actually accomplish real things. To know that there's a mission, and then at the same time to be in the position where you don't have to sell anything. That's always been a desire in my career. I'm a terrible salesperson. The great thing about journalism and being an allocator is, at the end of the day, you tell people to go F themselves if you need to, and you can't do that in the other parts of finance that have been branded as being so much sexier. And to be able to have access to, if you run a university endowment, basically anybody on the planet will take your phone call, right? It's the best job in the world. Why is it branded as boring? Maybe there's no reason to, there's no motivation behind making it look sexy, right? There's no PR campaign, but that's okay. I do, though, make it my personal mission when I happen to be talking to some young person who's in university or in business school, and they're like, yeah, I want to get into finance. I'm like, have you thought about pension funds?
And they're like, what's
and they're like, no. And I'm like, you should. Actually, do you want it? I can introduce you to some people. In fact, Canadian pension funds are the best ones. And they're like, Canadian pension funds? Yeah. So that's my side gig, is actually just promoting the industry.
That's incredible. I wish I knew you in college.
Well, and if I may say, it is definitely not too late. You're super young. There's no like direct pipeline to get into that industry. It's not like, private equity where, you have to play on the Duke lacrosse team and then go be an iBanker for precisely 3 years and then go to, one of 3 business schools and be a man, and then you can get hired into private equity. I mean, you are so qualified, and the industry has some amazing jobs. You should think about it.
Oh, well, maybe later in life here, we'll see where things go. But first of all, I just need to say how much I kind of love the anti-investment banker narrative. Quick story on myself for those who, sorry, not to hear me talk too much, but when I was in college, I feel like everyone had the same fantasy, right? About, I want to be an investment banker. That's the sexy thing. If you ask them why, they weren't really sure. Oh, it seems really cool. Oh, the money is great. You look at like a time broken down by time basis, and it's literally like getting paid less than minimum wage. It's kind of crazy if you like a lot of the people at lower levels that are just getting absolutely hammered with work. But other than that, I mean, right, there's so many like actually more fulfilling and like sexier jobs when you actually look at the day-to-day. For some reason, they have whoever does investment bankers PR. I'm guessing that's probably just the investment bankers with their big watches, but whoever does that is really good at their jobs, because there's really, when you look at the day-to-day and what a lot of people do, at least at lower levels, it is not sexy. I dated an investment banker for 2 months and I couldn't do it just because you're just like, your boss is like, you're just waiting for your boss at any moment to message you, and it's going to give you a heart attack. And you have to fix the fine print on a pitch deck, like you said, that no one's ever going to read. It's not necessarily the most rewarding. And institutional allocator land is just the reason I find it so interesting, right? Is you have these giant pools of capital, like you said. Anyone will take your calls. Everyone that I know that's worked in that space has said that the work-life balance of it is incredible, which isn't something that they advertise in school as often as they should. Is something to look for, but it's obviously really important. And it's just like a good gig. You get into really interesting investments because the time horizons are usually really long. You have investment committees that you're working with. You can get into a lot of really cool projects that might have your money locked up a little bit longer, obviously, depending on like what type of like institution that it is. Obviously, like, a lot more about this than I do, but it's just so fascinating to me from that perspective, at least coming from the retail side, where, oh no, we can't invest retail clients in this, or, oh, there's a nice ETF version that we can just do. That's not really necessarily as exciting. I think that there's a lot of opportunities on the institutional side that people don't talk about quite as much. On the like work-life balance question, I think that there's this fundamental divide between professions and careers where you have clients and ones that you don't. And if you work, my best friend does luxury travel PR. And when you have clients, they can all ask for something at the same time and you have to do it. Or lawyers, right? Investment bankers who are working for clients. If you're in the position of providing a service, then your time is not your own. Whereas when you're the one with the money, or the one who's kind of controlling access to something everybody wants, whether that's being a journalist or being an institutional allocator, you kind of get to call the shots, right? Unless a big story breaks, and then you do have to cancel dinner with your husband. But that's the fun work. Why did you decide to go into kind of like the community side of investing and finance and wealth management, as opposed to the money side, to managing? And we're turning the tables on this.
You have all the certifications, you have the degree.
Yeah, I mean, I think that there's a lot of things that can be taught from a technical standpoint, but there are a lot of things from a personality standpoint that can't. And I'm a firm believer in, and I did the CFA thing. I was like on level 2. I joined a tech startup and realized that that's just not a great use of time when I'm working on other things that are more exciting to me and more relevant. But I think that there are a lot of things that cannot be taught, and like how to manage relationships, how to communicate with people can only be taught so much. I mean,
how to be ridiculously good on Twitter. Most people, I'm just like, that is just a gift. Literally can't be taught.
Oh, well, thank you. Yeah, like even that too, right? I mean, I think I kind of had like this small epiphany, like maybe around like a year ago when I started looking for a new job. And everyone wants to put you into this sort of box, right? Like you said, it's like those traditional careers. You start as an analyst, you go to associate, you just move your way up. And that's like the expectation that you're going to have within your career. That's what you do in corporate. And there are a lot of people that works for. A lot of people like structure. A lot of people like to know what to expect. And then there are a lot of expectations that come along with that, with like what you should be. And I think it's all of those designations that you should be studying for to have the letters after your name, because those are relevant, and that, there should be more intent behind making a decision like that, in my opinion, for like time consuming things like a CFA. But I think I just realized that instead of trying to like fit that expectation of what everyone assumes that I should be doing, that I should just lean into what I know I should be doing and what I'm good at that other people aren't, that I enjoy. Like, what was I doing in my free time? I was meeting with people in the industry. I was talking to them about their careers. I was getting insights. So basically what I'm trying to do from this podcast, I was building community on my own. Like,
we're dating investment bankers
too. Yeah, I was dating investment bankers. I understood I didn't want to do that.
Live and learn.
Oh my gosh. And I don't know. I think that there's always going to be a place for that interpersonal contact and the skills that people have there that you can't learn from any test. And those are the really, really valuable things that I want to lean into. So I didn't expect to get into a job like this. Like, my now boss had mentioned the sort of community title to me after I expressed interest in working with him. And that was the first thing he thought of. And it never would have crossed my mind personally, but I love it. And it doesn't feel like work. And it's like one of those things that once you found that spot and you carve out a niche or a niche, whatever you want to call it for yourself, that you realize that's what you were supposed to be doing. So I think that there's always like the opportunity to go the other way, that like you said, like an allocator team, if I had the background and ended up wanting to do that someday, I think there's like a possibility to do that with like the different things that you do throughout your career. But yeah, that is the small spiel of my short career. But I think we all kind of need to have those epiphanies, right? Like, we don't all need to be doing the same things just because other people are doing them. Doesn't mean that that's the right thing you should be doing. And it's very hard to get out of the groupthink of it, especially in finance, where there's so many like sexy highlighted pathways that you're expected to take. And then, like you said, to your point before, I mean, there's so many jobs that you don't know are out there. That's especially true in finance, that you're probably not going to be doing one of those jobs anyways. So it's better to just get out of that mindset now, because the chances of you actually doing that role that you have fantasized about is probably pretty low. Not to crush your dreams, but
my cousin Clinton, who I will send this to, saved me from law school because, like probably many ambitious young people who aren't quite good enough at math to become a drilling engineer. I grew up in Calgary, Alberta. It was like oil business was the only business. You want to have a real job in a profession, and you think, I'll be a lawyer. And he sat me down over, I think, many cocktails deep when I was in university, and at his villa in Mallorca, where he retired after a career of doing sovereign bond origination. And he had gotten out of Canada and built this amazing life internationally. And he said, don't be a lawyer. And I was like, but he's like, don't do it. He's like, you don't, because there are so many jobs that you don't know exist yet, and you just need to hang in there and find one. But I'm telling you, don't do that. And he was correct. So thanks, Clinton.
Shout out to him. Thanks, Clinton. So getting into, I mean, we talked a bit about like your background, how you got where you are, but talking about what the investment folks listening to this would be curious to hear about. And I would as well, because you've been working in this space for, I think you said, what, 10 years? Like what has changed over those 10 years within the institutional allocator landscape? Like, what are the biggest trends that you've seen? I literally saw I think it was like a fire department pension or something recently investing in crypto. We can talk about that later. I'm sure that might not be the biggest change, but I'd be curious to hear what you've seen.
I think I always try to remind myself that, I have this very specific snapshot. So, I effectively have been the window, the time frame that I'm dealing with is post GFC. So it is the longest bull run in equity markets ever, and it's the biggest crash that I've ever reported on was like in March when markets went down a lot and then immediately came right back up and to all-time highs. And so it's been a good time generally for institutions. I would say, so trying to remove, my specific time frame from it. A change in the amount of private assets that institutions think are appropriate to have in a portfolio. We're moving into a space like where even listed equities are becoming very small portions of an elite endowments portfolio. I think perhaps the decline of the hedge fund. No one feels sorry for hedge fund managers, but I would say a real manifest change that's happened over my career is the death of fund of funds. So for very good reasons, a huge number of hedge fund of funds went out of business post GFC because institutions were professionalizing and realizing that they could actually select their own managers rather than selecting managers to select a manager to select securities for them. I mean, that is just like a huge amount of intermediation. My boss, Kip, I always joke that, like, see if you can find a hedge fund of funds of funds. How many layers deep could this go? It's like Inception. And so the thrust behind the almost extinction of this industry, where now there's only a tiny number of very, very good specialized fund of funds that remain, created a couple of interesting knock-on effects. One was a large pool of talent that had all of the skills of being excellent manager selectors, and that really seeded a generation of asset owners. Those people then got hired by pension funds, by endowments, because they came in with all the skills and the training, and their industry, just shedding people. And I think that's a great training ground. They're a little bit more commercial, to hustle a little bit harder. If you're a fund of funds, you are answering to clients, and so you can't get away with, a board that is asleep at the wheel or something like that you sometimes could in an institution. But another effect is that, became very, very hard to raise money and to get off the ground if you're an emerging manager who can't spin out from an established shop with 200 million in friends and family. It's almost impossible to stand up your own asset management organization now. And I think it's actually a little bit too hard, because another trend that's really happened is just this wave of capital from institutions into the largest asset management organizations. Bridgewater hasn't been good at investing, hasn't outperformed in a long time, but that is sticky money, right? Blackstone is just, it's just a juggernaut. And it's, I think, because there's individual incentives and the amount of work involved in giving money to smaller managers, just becomes on the margin the harder decision. So something I would like to see is a more vigorous seeding system for new managers. Because everybody knows that the evidence is basically incontrovertible that smaller, younger managers on the margin outperform large ones.
Yeah. So to that point, I mean, what would you
in general, not in the specific, but in general.
So kind of to that same point, I know you mentioned like seeding programs of some sort, but what else can emerging managers do to differentiate? Like, is it in the marketing? I mean, how does David slay the Goliath that is like these massive asset managers? Like, is it possible? Do you see that changing at any point, or do you see the trend continuing towards just staying with, I know you talk about like that sticky money. It is really hard to make a case to switch from that unless there's something like objectively very wrong going on, I feel like. So I'd be curious to hear your thoughts there.
Yeah. I think, what? Because I will often get asked this. I'm not sure. I would say that we're starting to see some very good programs at some institutions around putting money with asset managers that are not 100% owned and run by white guys. Massachusetts Pension Fund, I think, is an excellent example that they have built the infrastructure to meet state mandates of X percentage of state money needs to be with asset managers who aren't white dudes, or who aren't all white dudes. And they have a guy named Eric Nierenberg, who has a PhD from Harvard in behavioral economics, who's one of my absolute favorites. He's so good at what he does. Has very thoughtfully built this program where the same people who are running the assets that are with a Blackstone are in charge of also putting money with smaller emerging non-white dude managers. He's like, that was so important to me because you do not want to ghettoize this part of the portfolio. He's like, and what you do not want is for it to underperform, right? You have to have the same standards, but the same standards for performance and investment excellence, but be willing to invest more of your staff time, because it's not as efficient of a way to invest. And they decided, also because of the state mandate, yes, that's worthwhile. So for example, if you are a hedge fund that's 100% owned by white dudes, you'll probably email MassPrim, pitch them, they'll like read your stuff, 90% chance they're like, no, not interesting to us, and maybe send you an email saying thanks, but no thanks. Whereas they have decided that they will meet with every diverse manager who approaches them. It's like, we will do a phone call, we will do a meeting. They won't invest in most of them, but they will put in the time and they will write smaller tickets, right? Because if you're MassPrim, you're running like, I can't remember, maybe over $100 billion, I would imagine. And it generally would not be worth their time to invest $50 million in something. But because now part of their mandate is working with these diverse managers, it is, right? And so that's, I guess, where I see improvement. But on an individual incentive basis, nobody gets fired for hiring IBM, right?
No, for sure. That's just kind of kicking the can down the road with all of this, but it doesn't hurt them either.
Yeah, and you know what? The big ones, they're also doing fine.
Yeah.
It's a very, those places are not going to screw up and take your money and they're totally institutional quality.
Mm-hmm. No, that makes sense. So kind of looking within all of these different types of portfolios, talking about changes over the years, from an investment standpoint, I know you mentioned in this, I mean, this makes sense. It's kind of what I would have guessed, where there's less and less money in just traditional equities, right? You're going into more private vehicles, cooler projects and cooler, in my opinion, anyways, that, you could have your capital locked up for, a couple, like 5 to 10 years, because you have a different time horizon. That's the advantage in like the institutional world, typically, not to say that that's all the time, but what types of products, asset classes, investments are you seeing the flows going into most? Like, what's the hot topic of the past five or so years for these allocator teams?
I think the reality that you see on in aggregate is, even though these are all professionals, as an industry, performance chasing, right? So the money does always tend to flow into the things that have recently performed the best. And I imagine it's that way in retail as well. All of a sudden, like, my bartender is a day trader, and he's like, "Oh, you work in finance? What a hot stock!" And I'm like, I work adjacent to finance, and I have learned just enough that I will never purchase an individual security because Citadel is going to eat me for lunch. Like, I am, yeah, SPX baby. So a lot of where we're seeing money go to is the areas that have performed amazing: venture, biotech, private equity in all parts of the cap structure, and at all points of the life cycle. Those are, and very, very little activity with investment grade fixed income. It's actually becoming hard for people who have specialized as allocators in running bond books to find jobs, which is really sad. But because if 20 years ago, or maybe now at this point, let's say 30 years ago, the Canadian pension plan was just a bunch of Canadian treasury bonds, right? And now they would own very, very little investment grade fixed income, like anybody would. And so, yeah, I think that's, whereas I love fixed income specialists, because as people, equity specialists are always like a little bit salesy, right? Mm-hmm. Because their, job is like pitching something that's going to grow. Whereas fixed income people are underwriters, they're analysts, and they're often more technical, I would say, than people who specialize in equities. And I really like them. And so it's made me a bit sad to see, a lot of very good people having trouble finding homes. And then, in like biotech venture, it's just super, super hot.
Do we think it's just cyclical though? I mean, at what point are bonds back? Bonds will be back, baby. They'll have their time in the sun, I guess. But it is interesting to see, right? Even like personality wise, you say, like, I just, even like anecdotally at my old firm, just the personality types between the fixed income folks versus equities was like kind of hysterical to me, because it was complete opposites in a lot of cases. But
what was the stereotype?
It was, I mean, just like you said, like
archetype.
Yeah, the fixed income folks were definitely a lot more mellow, analytical, not really as much on like the social side. I mean, there were a couple that like clearly, were still pretty extroverted and whatnot, but just as a whole, a lot more quantitatively focused and everything that comes along with that, very detail oriented. Equity side is definitely a lot more enthusiastic and salesy and
to the moon, baby. Yeah.
Excited about like the growth and the opportunity, and really animated about that. So I do think that's funny too. But
I have two more to mention in terms of changes. One, the death of the short side. It has been almost impossible to be a short seller because the market is not behind you. And man, people love to whine about short sellers, but you're a CEO, put on your big boy pants. And B, I think it's very healthy for everybody. But the short, it's been nothing harder, I think, than being a short seller, other than doing real work, like essential work, like working in a hospital. That's way harder. And then the other would be I think, very sad decline of non-public pension funds. The thing I've really come to appreciate is how valuable to individuals' lives retirement security is, and that the 401k system, even everybody agrees, it's just not fit for purpose, right? And of course, the problem with defined contribution is unpooled longevity risk. As an individual, everybody has to secure their tail risk, right? You have to save as if you're going to live to 100, even though you know that in all likelihood you'll be dying with 20 years worth of money in the bank, but you have to fund your way all the way through. And we're being able to just simply pool that risk like you do in a defined benefit pension system. It's just such a societal net good. With you so much less money can secure the lives of so many more people. And also not to underestimate the anxiety and the stress that worrying about money in retirement puts under people when markets fell, I don't know, a couple of weeks ago. And my mother-in-law said, well, now I have to die 2 years earlier. I was like, oh, it's like, and that she is watching her TIAA account as the markets fluctuate. And I just, the public pension funds pension funds are now almost only for public employees, and they're a much better system than the one we have now.
Yeah, well, let's talk about pensions a little bit, right?
Let's talk about pensions.
Everyone was waiting for that. I mean, it's like the sexiest topic all time.
Talk about pensions.
But like you said, though, I mean, it's such a critical component of people planning for retirement that had careers like their entire careers with like the I guess assumption, right, that there would be like that pension money coming in after the fact when they're done. And you look at a lot of, at least within the US, and I live in Illinois, so talk about that a little bit, but like with underfunded pensions, yeah, yikes is right. But that I'd be curious to unpack. I mean, I don't know a ton on this, right? So curious for expertise, but like the underfunded pension problem that we've seen like prevailing in a lot of different institutions in the US. Like, what are you, I know that's a lot to say, but like, what are your thoughts there? Because it's insane.
It's a matter of personal incentive, right? As a politician, your time horizon is between now and the next election, or the time horizon of your career, right? And the time horizon of your retirement system, which you're in charge of funding, is far longer, and you're incentivized to make decisions that make people like you. And the political reward for funding and managing and governing well a public pension system is simply smaller than the public reward for not doing that, for directing money, cutting taxes, refusing to raise taxes, and making it the next guy's problem. And it's so sad because there is just this to watch like these amazing piece of public infrastructure and this huge public good be diminished by selfish political actions, right? And I think also in America, there's a real philosophical issue that creates this problem of underfunding, which is that people don't trust the government. They think that the government is going to waste their money, and so they underfund it to the point where, of course, the government is incompetent because you give them no money and no support, right? Like if the New Jersey Division of Investment, New Jersey's state pension fund, just lost their chief investment officer, who I think that was the last external meeting that I had was with their brand new chief investment officer. I had a huge fight with my husband because I insisted on going out to Trenton, taking the train. And we sat there in person knowing that like the world everything was closing up. And I interviewed him, and he's already gone. And over the course of my career, I think 4 very good chief investment officers have cycled through that place because you're running $80 billion and you make like $200,000 a year. You cannot pay somebody that little. And, you're dealing with the talent marketplace that is finance, right? Imagine how much money you would make if you ran an asset manager with $80 billion in AUM. Like on $200,000 a year in New Jersey, this is a very demanding job where you have to travel all the time. It's tricky. Your spouse, if you have children, needs to either have like a super flexible work from home job or not a job, or you need to employ like 2 full-time nannies, right? Because of the demands, and taxes and living costs are super high over in that area. Like it's just absurd. If you paid that person $500,000 a year, they wouldn't have to leave constantly and throw things into flux. And so the fact that like Americans just don't trust the government organizations makes it a self-fulfilling prophecy, right? The differences, the like A/B example of the quality and performance and outcomes of the Canadian pension system versus the American, everyone like loves to talk about governance, but really at its roots, it's just calm. It's just the willingness to pay people close to market rate, so you actually get good people running organizations. And there's so many great people at public pensions in the US, and they know that what they're doing is super important, but they're tragically underpaid. Their systems are underfunded because politicians don't want to direct money. You cannot invest your way out of this problem. It's a problem of inflows, not of return. Their job is, I think, it's too hard, and the people that are ultimately punished for it is everybody like you and I who will never have a public pension, right? Or which like we should. Like real societal net good.
That could be like a discussion in itself on like pensions, not in the future. Like why do we deserve them or don't? But my one last question, because you've mentioned it a couple of times, is Canada versus the US and the differences there. You said the trust. I mean, we could in relation to like allocator teams, not generally, because that philosophical discussion could be days long. But you've mentioned the differences. I know you said like difference in trust in the government and whatnot, but from like a procedural standpoint, what other differences are there that make Canadian pension funds versus US more successful, quote unquote, better, whatever other things you feel?
Yeah.
I'm not a big Canadian pension fund expert by any means. So,
well, have you ever considered working out? I'm so proud of my country and that system that they made. They're like arguably the best investors in the world. Although I did hear, all of the big Canadian pension funds. So Canada Pension Plan, Investment Board, CPPIB, and there's PSP, public sector. Anyway, it would be very, very boring if I just rattled off all of the great Canadian pension funds, but most of them have international offices as well. So they have people in New York, they have people in London, in Hong Kong. It's, pretty awesome that way. And I remember being at like a cocktail party and hearing an American staff member in one of the New York offices lament like, well, these Canadian funds, like you can't rise up unless you're Canadian. And it is true that I think Canadians love, especially when we're overseas, we just like find each other, brought together by the trauma of dealing with the US immigration system. Funny story, I actually was 7 days away from getting deported when I started my first job at CIO Magazine, because my company put in for an H-1B visa. I didn't get one in the first lottery. And so we were at the point where HR was like, I'm also an EU citizen. We're like, we can move you to London, but like you have to GTFO of this country, or you're going to, like, if you stay any longer, you'll be an illegal immigrant. And so I just started dating my now husband. And after far too many cocktails and serious stress about being deported, I proposed to him. And he said no. Because on the retaining wall, I was like, well, we could get married. I don't
Amazing.
want to marry you yet.
It worked out, though. It worked out.
In the end, I got the green card, had the anchor baby. So yeah, so as much as I'm a proud Canadian, of course, my job doesn't exist in Canada. There's not a big enough industry. That's a really hard part. And that's why these pension funds have international offices and very international portfolios. I remember hearing a story that one of the original people who set up Ontario Teachers Pension Fund and is really responsible for just changing the way that these institutions manage money, telling me about helicoptering into the Amazon rainforest to diligence mines that were in distressed financial situations because they were literally choppering in capital, and to take advantage of these, very promising, otherwise profitable mines that were in serious, need of capital to bail them out effectively. And going in, Ontario Teachers putting down, making deals on the spot, coming out, and he's like, the returns on those investments were just crazy, right? Like original distressed investing. And that, if you can do that as an institution. The Canadian pension funds are the ones, that everybody wants to partner with, and asset managers do not like to be on the other side of the table from. I was meeting a couple of years back with the head of private equity for OMERS, which is Ontario Municipal Employees, and institutional investor was up for sale. And I was like, hey, you should buy us. And he was like, no. I'm like, come on. I'm like, no, I'm not doing that.
Gotta try.
that was disappointing. But like, why can, Ontario Teachers like chopper into the Amazon to do distressed mining plays, and New Jersey can't even keep a CIO on staff because Canadians as a society have decided that we will pay people who work in public investing, and Americans have decided that they won't.
Man, mic drop. I have one more because I'd be remiss if I did not, other than asking what you like to do. And if you say get outside or don't, that's fine. But before that, I kind of alluded to this. There's been some news around, I think it was like a firefighter pension or something more recently announced, a large allocation to crypto. But have you seen a widespread, I've only heard like anecdotally through stories of connections that I have about the research that some teams are doing, pressures they're getting from their boards about newer asset classes, whether that's crypto or otherwise. I kind of mean crypto, I'm not going to lie. But other than that, what have you seen prevailing there? Is there a lot of interest on that side, or no. Where are they at in that process?
No, there's not a lot of interest. And of course, on the margins, yes, maybe, I don't know, I would say probably 1% of the allocators that I talk to have invested in crypto, which is obviously an anecdotal sample size.
Yeah.
But is strikingly different than the research and surveys that you will read. I think that as a journalist, like as an allocator, we have this allergic reaction to anything that is pushed that hard. There's so much incentive by everybody in the crypto universe to propagate this asset class, to push this story, that it's almost too much of a hard sell. And it's very, very difficult to separate what is sales and what is real information and research. It's also not an institutional mandate, right? being a first mover is generally not part of their job. This is an arena for rich people, people who and individuals. I think it makes much more sense to be established kind of in the retail sphere. And in the long run, if the story that crypto people are telling does bear out, then yes, of course, institutional money will flow in there, and they'll probably already have the massive initial upswing. But that's also not the job of somebody who runs a pension fund, right? So no, I would advise be very, very skeptical about the press releases that you get that are like 81% of institutional investors either are or plan to invest in crypto. I think the quality of the information around that sphere is very shoddy.
Yeah, no, that's fair. And that, small commercial on what OnRamp's doing and trying to like bring credibility and educational resources and whatnot that aren't necessarily to close a sale, but to get people actually up to speed. But yeah, it makes sense with like, I like the quote about, institutional allocators they're not there to be first movers, right? I mean, that's not the point of the job. It's not to make a quick buy and buy the dip and make a quick amount of cash or anything like that. They're playing the long game, right? So that makes a lot of sense. And I would assume that if anything, a lot of it would be more in research stage more than anything else right now than like putting mass amounts of capital towards that.
I am hearing, I would say at the best institutions, they have all, or almost all, have made someone the crypto person, right? Mm-hmm. Pick somebody on staff who has, a lot of authority, usually who's like younger and generally interested, and be like, hey, go learn about crypto for us. So they are building in the education so that so that they can watch with some insight. And I think that's the attitude towards it is great. I have seen though, because crypto is pushed so hard, some people like who work at institutions who in their LinkedIn like byline, Caitlin Cook, like Ontario Municipal Employees Retirement System. I don't invest in crypto. Do not contact me about crypto.
But what if I told you that you could make 10x on your return? No, I'm just kidding. Oh man. Well, that is really funny, just putting it out there. But yeah, I'm curious to see how that plays out. I'm sure time will tell on that, as it always does. But final question, and that I'm going to ask you this because we talked about it. But outside of being a journal superstar and doing all of the things that you do in this exciting land of institutional allocators that we all get so excited about, what do you do? What do you do other than that? What do you do in your free time? Do you get outside? Not an ad. What else do you do?
I do. I love being outside. COVID has been this global tragedy. And the ways in which that it has changed the texture of our lives are profound. And I think the reaction of being like a silver lining is in some ways gross, but is also real. Just like World War II is an absolute tragedy, but it put women into the workforce for the first time, right? It's hugely responsible for some really, really important social shifts forward. And I think that the ability to get outside working remotely has just vastly improved. Like I like to run. That was something that I started doing during the pandemic. And I love to ski. I was a competitive skier for a long time. 2 blown knees later, I figured I needed to make a new plan, and pension reporter it was. But that's a really important part of joy in my life. And I have a little baby.
Oh, well, congrats on the baby. Hopefully they'll be working at a Canadian pension fund in a couple decades. So I'll have to check back with you on that.
He's going to have 4 passports. So I'm like, baby, if I can give you anything, it's not to have immigration problems.
No kidding. No need to repeat that. Gosh. Well, congratulations on the baby, first of all. And then secondly, thank you so much for finally being on the pod. This was so much fun. I feel like we could have talked about pensions for a long time, which says something, because it's really hard to do that with a lot of people. So thank you for the time. This was wonderful. Where can the people listening find you to follow all of your musings?
If you run an institutional fund or a consultant who doesn't sell anything, I strongly suggest that you get my newsletter. I am now effectively a gossip columnist about investing. So I run a newsletter that is free to those who allocate money, impossible to get for anybody else. Actually, a lot of hate mail from hedge fund managers who are like, "You mean I can't buy a subscription?" And they're just enraged at the idea that there's something that they want they can't purchase. So to subscribe, just find me. I am so Googleable. There's only one other Leanna Orr who exists, and that bitch took the Gmail address. She took the Twitter handle. And many moons ago, I tried to add her on Facebook as a friend because we're the only two Leanna Orrs, I think, that exist. And she didn't accept my friend request. So she's my nemesis, but I have a much larger presence than her. So Google me. I'm on Twitter, LinkedIn. And everybody should know, journalistically, I practice radical consent, which means that anytime you talk to me, phone calls, emails, any communication is confidential. I would never quote it. If you're on the record, you'll know.
Perfect.
Yeah. So I'd love to hear from anybody. And thank you so much. Thank you for the work that you do for women in the industry, and for you're a real force for good.
Oh, well, thank you so much. That means a lot. And I really appreciate that. It's what we're trying to do here at the Chicks of FinTwit podcast, have people on like yourself. So that means a lot again. So thank you. Thank you for being on. Thank you to everyone for listening. And we will be back next week with another episode.
Bye-bye.